Welcome to the current federal tax developments for the week of May the 28th, 2019. Current federal tax developments are brought to you this week, as always, by Kaplan Financial Education and by your state societies of CPAs. I'm Ed Zollers, reporting in this week from Phoenix again, doing a relatively cool Phoenix for this time of year, so we're not upset about that. And we'll be talking this week about some developments that have taken place in the area of taxes, including what might be a new tax bill. But we've got a 1 week reprieve at least before that bill could become law. So we'll talk a little bit about that. We'll also talk about the IRS Commissioner indicating that the agency expects to issue new guidance on virtual currencies. We have the first inflation adjusted numbers for 2020. Those are the health savings account numbers for that year. We also have inflation adjusted numbers for 2019, kind of the last ones. These are the auto depreciation figures for this year for the what we normally refer to as our luxury auto rule. We're going to also talk about a warning from an assistant U.S. attorney that warned tax preparers about the dangers of reporting receipts by a client as loans without doing sufficient inquiry to make sure they're not taxable income, and how they can get a tax preparer into criminal problems with the Justice Department. And finally, we'll take a look at a brand new tax bill that at the end of this week suddenly came forward and actually passed the House close to unanimously. It only had 3 no votes, but stalled in the Senate when a single senator objected to a unanimous consent to suspend the rules, and then the Senate took off for the week for the Memorial Day recess. So we got a week to kind of consider this, but we will talk about what's in there because it does appear to have broad bipartisan support. It also appears that it seems likely it'll happen. Put it this way, the senator who objected to going to a vote on the bill does not actually object to anything in the bill itself. So we'll talk a little bit about how that works out. Well, I think as I told everybody last week, this past week, I spent a couple of days in the New York City, New Jersey area. And on Tuesday, I spoke in Somerset, to the chapter of the New Jersey Society of CPAs in that area. And we talked a bit about deferred compensation, etc. I will be coming back to New Jersey on June the 19th. I'm going to be talking about multi-state taxation, income and state taxation after Wayfair. Probably also have a little bit of discussion, at least some speculation, on how the Supreme Court may look at the Case Trust case. While that's not technically a business case, it very well could have impact on business taxation depending upon how the Supreme Court decides the case. We will be holding it at the Wilshire Grand Hotel in West Orange, not at the New Jersey Society offices, because as those of you in New Jersey hopefully are aware, the New Jersey Society is moving their offices. And while their move is not complete until July 1st, we can safely assume, with us relocating to the Wilshire Grand, that they're not exactly ready for us to all come rolling in then. It's like got to pack things up and go. So on the 19th, we will be having our session at the Wilshire Grand. Let's get started this week with what's happening. And this week, the office of Representative Tim Emmer, Republican from Minnesota, announced that there had been correspondence that the congressman's staff, technically the congressman, but normally these things are handled by congressman's staff, had with IRS Commissioner Tim is the congressman, with IRS Commissioner Chuck Rettig, discussing issues and questions that the representative had regarding guidance on virtual currencies. Obviously, it's become a big topic over time. And the commissioner responded to concerns from the representative because the representative pointed out that there are a whole lot of unanswered questions about how we should be handling virtual currency issues. When a taxpayer, essentially buys or acquires virtual currency, be it Bitcoin or some other type of virtual currency, how we account for those things. And while the IRS had issued a notice in Notice 2014-21, left a lot of things unanswered. The commissioner told the congressman that the agency expects to release additional guidance beyond that found in Notice 2014-21 here in the near future. And the commissioner specifically referenced 3 different areas that this guidance would take a look at. first thing to talk about is going to be issues of how to calculate basis of your Bitcoin. And probably looking at things other than the simplistic approach where you just go buy Bitcoin for cash. Obviously, there are a lot of other transactions. Certainly, we'll get back to situations where you exchange Bitcoin for something else, or maybe you get Bitcoin in exchange for something else. And how exactly do we calculate the basis of the Bitcoin if we perform a service or something of that sort? We'll talk about rulings there. My guess is in cases like that, we're going to look at a lot of cases with exchanges that involve Bitcoin where the value of the Bitcoin itself may be very volatile. And part of our issue is I might have agreed to do something for X Bitcoin today. By the time I actually perform the engagement, the value of that Bitcoin has moved, and the way Bitcoin was jumping around, it could have moved dramatically. The question is going to become, well, at what point in time do we value that Bitcoin? What point do we give it a basis? And that's going to be one of those things to deal with. I'm sure there's some other problems there. We'll look at it on basis. We also want to talk about the issue, which I think is also key with Bitcoin, is what they're referred to as assignment of cost basis. But I think the way you can think about that more is we know from those 2014-21 that Bitcoin is considered an asset. It's not considered a currency. And because it's an asset, essentially, whenever you dispose of that Bitcoin in a sale or exchange, you're going to recognize gain or loss. Now, we got a selling price here, which is fine, whatever that might be. But the question is going to be, how do we assign the cost? We've acquired Bitcoin in various transactions over the past 3 years, and now we've sold some amount of Bitcoin. Do we assign our basis to that on a FIFO basis, on an average cost basis? Can we do specific identification? If so, how? What's the nature of this? Because the Bitcoin is not really a physical something. It's essentially a right. And because of that, how do we assign that when we've acquired those pieces of Bitcoin in various transactions? Maybe some of them we mined, maybe other ones, as I said, we got from purchasing, we got them with the very volatile market. We had lots of things happen. And obviously, which of the Bitcoin we're considered to sell, or if we have to do an averaging method, is going to be key. Finally, and this was actually one that caused a lot of problems, not last year for 18 returns, but 17 returns, is the treatment of forks. Well, we still have forks otherwise. Now, for those who don't know what a fork is, I'm not talking about that thing you eat dinner with. What a fork is in the Bitcoin world, we had this where we split. And forks is borrowed from the terms borrowed from open source software in general. And Bitcoin is an open source concept, at least, even if it's not really software per se. But the concept is a fork basically takes a project, but then makes a hard break. In essence, we're going to make changes to that project, but that's going to develop on its own path. We're not going to fold back our changes into the old project. Specifically, we had an issue, and we've had some discussion. We've had various things spun out of Bitcoin. There are various things that people have suggested maybe Bitcoin was not, thought through totally, that it doesn't quite work for certain things. We need to make changes. One specific one was a change to Bitcoin Cash, because it turns out, due to the way Bitcoin was structured, transaction costs, which in theory, one of the things was going away with Bitcoin, actually turned out to be getting pretty high because Bitcoin wasn't really built well to scale well to the size it got to, largely because nobody, I think, really thought when it was brought forward that it'd ever get quite as big as it did. So we got back in 2018 or 2017, we had a fork of the project into this thing called Bitcoin Cash. And to get that new project going, it provided, essentially, it took the blockchain. Those who do Bitcoin know what that is, basically. And it took a copy of the Bitcoin blockchain at a point in time. It then basically duplicated that into Bitcoin Cash. So meaning that everybody who had a Bitcoin or any amount of Bitcoin ended up with an identical amount of Bitcoin Cash at that point in time. Now, the question becomes, was that a taxable event? Or was it some sort of division? And if it was some sort of division, how did we divide basis between Bitcoin and Bitcoin Cash? And there was a lot of discussion. Now, in 2017, it was still theoretically possible, some people tried to argue as a 1031 exchange. But obviously, after 2017, 1031 exchanges don't work for anything except real property. And we know that Bitcoin's not real property. So we're stuck with this problem, even if that like kind exchange theory maybe worked, and a lot of people wanted that to work back in 2017 as a way to try to do this. And it's still up to problem. Then how do we deal with the basis? It does not going to work in 18 and 19. So we want to have some guidance. What do we do about forks, especially forks where we have things like Bitcoin Cash, where you may still be a Bitcoin adherent. You don't think Bitcoin Cash was crazy. You're not really thrilled of it, but you've got Bitcoin Cash now. I mean, is that a taxable event for you? And that's some of the crazy problems. The service is going to look at giving that guidance. And again, now the commissioner didn't tell us when. It's soon. We don't know what soon means. Does soon mean next month? Does soon mean next year? Does soon mean before the next decade's over? We're not sure. But it does mean that at least somewhere inside the IRS, they're at least considering the problems of the virtual currencies. Well, we have a couple of inflation adjustment issues coming up. And the first one is the annual revenue procedure for health savings account numbers, this time for 2020. Revenue procedure 2019-25 issued on May 24th. The HSA numbers for a year are usually the first set of inflation adjusted numbers we get from the IRS for any year. They're normally issued early in the year prior to the year when they apply. And they're not quite as early this year as they've been in the past, but they did come out here on May the 24th. And it gives us our inflation adjusted numbers for 2020. The most important thing to remember about what I'm going to tell you is these are not the 19 numbers. These numbers work next year when you're doing 2020. So these are ones you pencil in for next year's numbers, but they're not the 19 numbers, and certainly not the 18 numbers that are for last year's returns. So for next year in 2020, the maximum contribution to a health savings account will be $3,550 if you have self-only coverage. That's your qualifying coverage. Now remember, you got to have qualifying coverage, and you cannot have any disqualifying coverage. That applies if your plan is self-only. $3,550 is your limit. If you have a family plan, which is essentially under the HSA rules, self plus anybody. It could be your spouse, it could be your child. But self plus anybody, spouse, child, we don't care, spouse and two children, not spouse, but we include two children. Doesn't matter, that's a family plan. Your maximum contribution to that health savings account will be $7,100. Now, remember, much money goes into an HSA. Even if my spouse has disqualifying coverage, I can still take money out of the HSA to pay the medical expenses of my spouse. It's kind of interesting how that works. Because the issue there is for funding the account, but paying medical expenses out of HSA do not require you to not have disqualifying coverage. You just can't have disqualifying coverage if you're funding. That's where the fundings are turned based on that. So interesting history there. Now, in order to do this, you got to have this thing called a high deductible health plan, generally abbreviated HDHP. And HDHPs have to meet certain requirements. Okay, now again, the plan has to be one that does not provide for any payment of medical expenses except for certain accepted items, and that includes certain preventive care issues are in there. But it can't make any payment until you've incurred at least $1,400 of expenses, qualified expenses, if you are self-only coverage, $2,800 worth of expenses if you are family coverage. Remember, on the family coverage too, that's $2,800 for the whole family. It's not like broken up $1,400 a piece. So $2,800 for everybody. Now, this is the minimum deductible. An HDHP plan could have a higher deductible than that. It just must have a minimum, and it cannot pay anything until the deductible is met. Now, there is really a top end cap on deductible because the policy has to provide an absolute cap on out-of-pocket costs. Now, with an asterisk, this is limited to in-network providers. So if you do something with an out-of-network provider, the plan can still have network providers and not pay for out-of-network or give basically any credit for that. But your maximum out-of-pocket is $6,900, and this is per year for self-only coverage, and $13,800 for family, which means self plus anybody coverage. Again, remember, this is for next year. This comes out early primarily to let employers who have such programs and insurers that are setting up basically policies for next year to qualify for this, to have plenty of time to basically design the policies, set them up, get the policy submitted for approval to a state agency that approves medical coverage, and then gets everything set up and ready to go so that by next January, when this will apply, there'll be plenty of time to get all this done. So this definitely is early. Just remember it comes out early, but hey, it's what we have. It's for HSAs. Now, on the flip side, we have another set of numbers that come out fairly late. This is the auto depreciation limits for Section 280F. Now, a lot of you refer to that as the luxury auto rules. It's actually never quite called that in the code, but that's what a lot of people refer to it as. Now, these are the numbers for autos that are first placed in service in 2019, and it's a weird table this year. The table you're probably looking for if you have a car that is first placed in service in 2019 and acquired in 2019, and for which you're going to use bonus depreciation. The maximum amount that you can claim the first year as depreciation is $18,100. The maximum claimed amount in year 2 is $16,100. The maximum claimed amount in year 3 is $9,700. And the maximum claimed amount for year 4 and later is $5,760. Now, the table actually contains information on how much you get if you do not go for any bonus depreciation. And if you do that, the first year is $10,100. The other numbers remain the same. And it had to include a third table because what happened if you bought a car in late 2017 that qualified for 100% bonus, but you didn't place it in service, right? Or I should say, you bought a car if you bought it in late 2017, placed in service later, qualifies for bonus. What if you bought a car before September 27, 2017, which only qualified for 35% bonus? What are your numbers then? We actually have a table for that. In case you're like, one of the 5 people listening to this that might have to worry about that. If you did that, your first year limit is 14.9. So that's a car you might have acquired in June of 2017. You didn't actually put it in service for business use until 2019. Well, then you're going to get 14,900 on that car for the first year, not 18,100, because the date you acquire the car is what actually triggers whether or not what its bonus number will be, but you can't get the bonus till it's placed in service. Neat mess. Don't forget, we talked about last year, there is a special ruling the IRS has because as we discussed last year, the way bonus depreciation works, or the way depreciation works in 280F works under the old regulations, you end up getting nothing after the first year until we got to the end of the regular life of the car. That old ruling still in place. Don't have that ever changed. So go back, refer that. Just remember it's a little complicated. Also remember that it still seems to be a problem. Take 179 in the car in year 1. You are going to still get those 0 years afterwards. So that goes back a ways. You can check the history of the podcast. You can check it online, currentfederaltaxdevelopments.com. We discuss with you the problem of 100% bonus depreciation and what the IRS has done. Essentially, the IRS says in year 2, just consider the amount that essentially was not subject to bonus depreciation as being the total original cost and use that under makers and compare that to your numbers. And then we finally get to the finish time, then consider whatever's left over at that point as being the part that was disallowed the first year and take that over time. Again, it's a little bit easier if you go read that because it's a little tough to explain without going through a lot of details. But yeah, remember that's still sitting there. Now, big thing happened here toward the end of the week. The House of Representatives passed by a 417-3 vote the Secure Act. Now, the Secure Act, I love it. We're getting at least better acronyms now. This is the Setting Every Community Up for Retirement Enhancement Act. And of course, they did that because that would spell secure. Congress is back to, TCJA didn't spell anything, but this one at least spells something. So Congress is back to doing this thing. Remember the PATH Act? Remember COBRA? So we're spelling something. We're now to spelling something again. So we're still getting more creative, unlike TCJA, which of course isn't really TCJA anyway. We're a little more creative. Now, this bill makes major changes in retirement accounts, including IRAs. The key issue is this is probably the most significant pension changes we've seen, retirement plan changes. I say pension, but I really mean, for the most part, defined contribution style plans. This is the most significant changes that would be made since the 2006 Act. So, it's been 13 years since we've actually gone back and done something significant with this, and it will make some significant changes, both pro and con. Let's first focus on what the good changes would be, because it does provide a number of benefits. One nice thing I'll do for those of you that work with business, it would allow you, remember right now, if I'm going to adopt a profit sharing plan for 2019 for my Schedule C business, I have to actually sign the adoption agreement before December 31st of 2019. The only type of retirement program I could set up after the end of the year would be a simplified employee pension, a SEP. A SEP I can set up through the extended due date of the return. This law would change it so all of the retirement plans would effectively have the same rule as the SEP. Now, there's still going to be some complications because you can't really do a 401k deferral, that late after the fact. You have to defer it from your wages, and obviously you can't do that late. But things like a profit sharing plan clearly could be set up all the way through the extended due date of the return, which for a individual return or for actually a C Corp even, this calendar year would be October 15th. For all other sponsors, it would be September 15th. I guess theoretically, there might be a case where a trust is operating a business and then maybe we get to, September 30th, but I don't see that happening very often. So that'd be kind of a nice change, because I know quite often in the past, I've told people when we've talked about this in tax planning courses, that after the end of the year, that's when you might have to use a SEP for the first year and then use a more traditional qualified plan for the second year, because the client comes to you in February. It's a new client, and all you can do in February is do the SEP. Now we'd have a couple of other issues. The program is meant to make it simpler to set up multi-employer plans. It would eliminate the one bad apple rule. One of the problems with multi-employer plans is if you have one bad apple, one bad actor employer who's not complying with the requirements, that technically taints the entire plan. So it would do that. It would set up a way to have a multi-employer plan, even if the parties, the various employers in this pool have nothing in common except offering benefits. The benefits right now, that kind of structure violates ERISA. And so instead, we end up having to treat that as a bunch of separate plans. This would change that particular rule. It would revise the start minorly of requirement minimum distributions from 70.5 being the date to 72. So your distribution has to begin by April 1st of the year following the year in which you turn 72, as opposed to after the year in which you turn 70.5. That'll be interesting. Do that. That pushes it back some. I don't know that's a huge change, but it is a change, so we'll accept it. It would change the 5-year rule. Remember, with inherited IRA right now, if I inherit an IRA defined benefit plan and it's not yet in pay status, we would take that from 5 years. Right now, I have to pay out everything by the end of 5 years. That's one of my options. We're going to have a problem with the other option here, but we'll talk about that later. Now it'll kick it out to 10 years. It would also make this 10-year rule apply regardless of whether or not basically the person who was being covered, the employee or the IRA account owner, was already in pay status. So it was already over 70.5, or in the future, I suppose, 72. The 10-year rule would come into play. We'd also get rid of the rule that says you cannot contribute to an IRA once you are basically past the RMD date. You could now be 92. If you've got earned income, you can put money in an IRA. So we would save that particular problem. But those are probably generally good things. But by the way, the 5 to 10 year is going to telegraph where one of our bad things is. It's got certain issues. So let's talk about those issues. In this case, for qualified plans, it would require those that offer cash or deferred arrangements, which would be basically 409, basically we talk about we talk about 401k plans. We talk about other types of 403bs, etc. Up to now, you didn't have to let anybody in your plan if they didn't have at least 1,000 hours. Now it would say, at least for CODA plans, plans with a cash deferred arrangement, you'd have to let people in if they have at least 500 hours. We'd go from 1,000 to 500. That would be a requirement. It would also require you to have a disclosure each year when you give them their account balance. We would have to tell them what lifetime income could be generated off of this. This is part of a more general program that they're going to encourage defined contribution plans to offer annuities as a benefit. And obviously, one of the simplifications here is that if you go sign up for an annuity provider, we know how much the annuity provider would pay based on this account balance. So essentially, we could do that. That would simplify that calculation. But you are going to have that. Every defined contribution plan, that means profit sharing plans, 401ks, that would also include, in this case, employee stock ownership programs, any other type of defined contribution plan would have to have this number. A plan, now at this point, it only covers defined contribution plans. So as I read the bills that exist right now, it would not cover cash balance plans because those are defined benefit programs. They have deemed accounts, but not actual accounts. And so that'd be a little different, but that's not really a major problem there. They'd also have, and this is probably the big one, it's getting lots of coverage. We would have a major change in the rules for an inherited defined contribution or IRA account. As I say, generally, instead of having that option of 10 years, right? Instead of saying, the 5-year rule only applied if we weren't in pay status yet. So if the employee or the owner of the IRA account was not yet over their required minimum distribution date, they hadn't yet cleared that date, then we had the 5-year rule as an option. But if they were already in pay status, you no longer had the option of the 5-year rule. Now the 10-year rule will apply. We won't care if you're in pay status or not. We get the 10-year rule, which replaces the 5-year rule, but it's the same. So the entire balance has to be out of the account by the end of the 10th year following year of death. However, we're also going to get rid of the ability to take lifetime distributions for most beneficiaries. If you've done a lot of planning with what we refer to as stretch IRAs, that's got to radically change. Most beneficiaries will not qualify to take the balance out of the account over their life expectancy. So if your planning had been you were leaving the IRA to a great grandchild, because the great grandchild is like 2 years old, and the great grandfather or great grandmother is 98 right now, not in great health, so it's going to pass this great grandchild. We'll get this distribution over an extended period of time. We may have put it in a conduit trust to just force it to be stretched out that long so the kid couldn't go cash it in when they turned 18 and use it to get a Porsche. That kind of planning, not going to work well anymore. We're going to have problems there. And so we'll talk about it. Now, there are some exceptions here. First thing is, it does not apply to what's called eligible designated beneficiaries. And so that means if you're one of these, you can still take, in lieu of the 10, you can use the 10 years, or you can take it out over your life expectancy. And the first category is a surviving spouse. Now remember, surviving spouse would still retain the right. This doesn't change most anything else. So surviving spouse could still treat the IRA as his or her own. They could still roll the profit sharing fund balance into an IRA that would be treated as their own. So that option is still there. But if they treat it as inherited, then they could still use a life expectancy. Their own life expectancy, they would not have to. Also, the special rule that would let them delay till the age at which the original account holder turns 70 and a half, or 72 now, these rules would still apply. So all of those rules would apply. Surviving spouse, special case. Second special case is if the beneficiary is the minor child of the deceased employee or the deceased owner of the IRA account. Now, a couple of key things here. First, you should have an asterisk. This only allows payout over the child's life expectancy until the child reaches the age of majority. Once the child reaches the age of majority, we start basically a brand new 10-year period. And within 10 years after that date, the money has to leave the account. So it's not going to be able to stretch it over the entire life of the child. We're going to get it through the date they hit majority. When they hit majority, we're going to have 10 years to get it out. That would still work just fine for using that for like the child's college education money, but it's not going to stretch for lifetime to the child. So there's an issue there. Number two, note, it's very clear. It has to be the decedent's child. It's not good enough if it's a minor. If it is your grandchild, it doesn't count. That is not a eligible designated beneficiary. If it's your niece, it's your nephew, it doesn't count. That's not a eligible designated beneficiary. It has to be your own minor child. If it's not your own minor child, now that would include adopted children, but if it's not your own minor child, it doesn't count. That's not eligible designated beneficiary. The 10-year rule comes into play. We also have special rules for disabled individuals under 72M7 and those that are chronically ill. Chronically ill takes a look at the rules that apply to those for long-term care rules. Okay. Now, there is a little asterisk on the chronically ill. There does have to be a determination that the condition that currently qualifies them for that type of test is one that is of indefinite and an expectedly long duration. May not be lifetime, but it's got to be for a long duration and maybe uncertain duration and expected to be long. And that has to be certified by the physician, who also has to certify the other aspects as they do under long-term care rules for that to work. So we have that. Finally, the final category that's a designated current beneficiary, if you leave it to somebody who's less than 10 years younger than you, then you qualify as a designated beneficiary. So let's say my brother is 5 years younger than me. If I leave my IRA account to my brother can use his life expectancy as a payout. That's because the theory of this is there's not a super deferral going on here. So I leave it to somebody who's within 5 years of my age. If I leave it to somebody who is 10 years and 1 day after my birthday, bingo, they have a 10-year rule. So yeah, those are the rules in place. It's going to really foul up any sort of IRA planning you've done where there's been looking toward doing any sort of stretch. This would have a major impact on all stretch planning. So be aware of that. This is how they pay for most of this bills, is by getting rid of the stretch capabilities here, which frankly are mainly used by higher income individuals. And the idea is, well, we're going to force them to pay tax faster, right? So basically, as I said, we'd look to eliminate the stretch IRAs. It would apply to any interest inherited from a person who dies after 12/31/19, with a couple of exceptions. State and local government plans would get 2 years extra to implement this, and collectively bargain plans could get up to a year extra, depending upon when the collective bargaining agreement expires that governs the plan. There's a special rule if you have an annuity in the plan that was in existence before the date of enactment. Because that might by contract have a payout on the death that's not going to fit the 10-year rule. But after this date, if you modify that annuity or get a new annuity, that annuity has to comply with this new 10-year rule. So we have to have that. There are some provisions in this law that have immediate effective date, especially those impacting retirement plans. So you need to be aware some of these things you're going to have to get up to speed fast. Senator Grassley and Wyden in the Senate want quick action on this bill. They both indicated that. As I said, it was passed by the House on Thursday. On Friday, Senator Cruz from Texas objected to the bill coming to a vote. The Senate was trying to vote on this thing immediately. Now, they don't want to vote immediately because of retirement parts. So why they want to vote immediately is this has the kiddie tax fix that is significant for children of Gold Star families. And those who are getting taxable college aid, and we've run into a few other categories where those people who saw their tax go way up in the kiddie tax because mom and dad are in a low tax bracket, and Congress hadn't quite thought this through when they switched it over to trust. That provision would kick it back to the pre-Tax Cuts and Jobs Act version of the kiddie tax, which is complicated, but it does solve the problem of the kids being taxed at a way higher rate than the parents on unearned income. So we're probably going back to that. Now, Senator Cruz objected because the House, after this passed the House Ways and Means Committee unanimously. There was provision there that stuck into this bill, that 529 homeschooling item that you may remember got pulled from the Tax Cuts and Jobs Act at the last minute due to an objection on the floor that it violated the Byrd Rule. So they put it in here probably to placate everybody. Ted Cruz, who was the one that tried to get the first one through. It was in there. It was supposed to make everybody happy. Then certain objections occurred to it from certain sources. So the House pulled it because it appeared that could torpedo the bill. It went through the House clear without this. But when it got to the Senate, Senator Cruz was upset it was gone. He did object to the vote on Friday. He has not said whether or not he is going to still try to keep that from going to a vote come Monday, which will be a week from Monday. Actually, I think June 3rd is, I believe, when they come back, or whether it's going to take some additional work. But the takeaway from this was because of the I think they call it a work period now, is what they call it, because it sounds better than a recess, because Congress gets a lot of recesses. That sounds like vacation. So they're back in the district work period. That goes on for the week of Memorial Day. So this will be sometime in June. If in fact this goes through, I will let you know. I've been in discussions already. We've been talking here at Kaplan. I've been in discussion with some state societies about looking at getting a program out there. Could be a webcast, or it could be a live program. Obviously, we can't say much about anything yet because we have no idea when or if we'll get the law. But be aware we're looking at that, because yes, there may be some things you need to move on to at least understand how this changes the IRA rules. Certainly, I would say that if you're right now talking to somebody about an IRA beneficiary designation and we're discussing the possibilities of leaving it to someone that could stretch it out, you might want to suggest that maybe we're going to have to revisit this once Congress does something. And I don't know if it pay a whole lot of money to go get a conduit IRA, a conduit trust put together right this instant, because it may not be worth much after a few days, at least after the end of the year. You might want to do something else temporarily to tread water in case somebody dies in the interim. But basically kind of watch that and keep an eye on this bill. Finally, we had an article that it was interesting to me, Kristen Perillo, an article that she wrote, Preparers Warn to be Vigilant About Documenting Loans, that was in Tax Notes Today on May the 20th. And Kristen, a reporter for Tax Notes, was quoting Christopher Schmeiser, an assistant U.S. attorney in Connecticut. He was speaking to a law school conference, and he was talking about tax fraud, and was talking specifically about criminal, basically your criminal assistance of tax fraud by a tax preparer. And what he said in his comments was that they have seen a problem with preparers, and they have prosecuted. Again, this is U.S. Justice Department who files criminal prosecutions in this area. They had prosecuted CPAs and other preparers who had been allowing their clients to treat payments as loans, non-taxable loans, when in fact they should have been taxable income. They had not properly followed up. They had not checked to see if there's proper documentation. They had not done any real due diligence on the reality of the loan. They had just treated it as a loan because that kept it from being taxable. And yes, there have been criminal prosecutions. Now you might say, that's just somebody threatening things. There's not really been an actual prosecution, has there? Well, actually, yes. We'll talk about here in just a second. The key thing to take away is, as a preparer, we need to worry about, is a loan real? And let's talk about what a real loan is. You have to look at, the tax court has looked at various factors over the year, tax court and other courts, to see if something's truly a loan. A true loan, and some of the factors you look at is there a document that shows actual terms, interest rates, repayments, when we got to make the payments, all those things. And I'll be honest, has anybody been enforcing it? Number two, is there any real intent of the parties to ever have this loan repaid? Can the borrowers ever realistically repay the loan? Or is that a pipe dream? Is an appropriate rate of interest being charged on the loan, given the terms and the risk involved? You got somebody who just came out of bankruptcy last year, they probably shouldn't qualify for a loan at a sweetheart rate. Just the way it works. Did you consider the need for security for the loan? What security did you get? And did you take the normal steps to secure the debt? If it's supposed to be secured by their home, did you record that, that basically that lien on the property? Real loans would record that. Non-real loans would ignore it. Did you, was the loan enforced by both parties? If you said they were going to repay this loan over, with an equal monthly payment over 60 months, beginning a month and a half after the loan was given, was that payment actually made? If it wasn't made, was action taken? If that payment, if we've now gone 3 years, they've never paid on that loan, that doesn't look like a loan. That looks like something else, like compensation or a dividend, or there's lots of things it could be that are taxable, but not a loan. That it doesn't look like, right? And if it's with related parties, that's especially open to question. Related party transactions are always subject to special scrutiny by the courts. Now, I talked about actual prosecution. There was a nice long discussion last year, it was during 2018, about the case of a CPA in California who was actually jailed. At the end of the day, he was sentenced to jail time for aiding and abetting. And this was a CPA who'd been in practice for years, who many of the people on the board in the area knew of him. He was upstanding. Everybody said he's one of the most honest people they knew. They just couldn't believe that, that he was being thrown in jail for this. He was being prosecuted and convicted. But the case went down. Now, I quote an article there from Peter J. Riley in his Forbes blog, talked about this case as well. What happened in this case, the CPA was doing the tax return for a gentleman who essentially was collecting management fees from basically running all of these investment funds. And it turned out he got in cash flow hitch. And so he claimed he started taking advances against his management fees. Now, it really caused the CPA problems about how to report that, because they were advances. Were they advances? Were they really advances? Which meant that, according to his client, they were loans, and they were loans which the client was very sure were non-taxable, because you don't pay tax on loans. The CPA actually did quite a bit of research trying to figure this out. Now, the interesting part was these funds that he got these advances in quotation marks from were funds that were currently being audited by a Big Four accounting firm who gave them clean opinions. The notes describe these quote unquote loans as existing. The tax CPA, one of his defenses was that, look, the auditor said this was a loan, and I didn't question the auditor. Now, by the way, the auditor in this case, when things finally come down, that particular person in charge of that audit was disciplined for this case, also suspended from SEC. There was a few other things happened described in Peter's article. So unfortunately, the audit kind of had a bust. Now, when this guy was discovered not reporting it, and what happened was his advances ended up being more than he ever could have earned in fees from this fund. Okay. So the answer was, the Department of Justice came in and said, no, the reason why he called them, what he really was doing was embezzling, effectively, is what they were saying, because he was taking money that could never possibly be his with no intent to repay. That's taxable income. And he eventually pleads guilty to tax fraud based on that. And he quasi turned state's evidence against his CPA. Of course, apparently alleging the CPA said it was all okay. The CPA, of course, says, I didn't say, I relied on him and I relied on this audit. But the problem was that he actually did at one point discover that there was nothing in writing about this, which bad thing, right? So he had him do these in writing, and he did. He did written notes, and he signed them. And then as soon as the CPA went away, CPA made copies of those notes, put them in his files. As soon as that guy then picked them up from the CPA, took them out, and immediately destroyed them. He didn't get back to anybody because it didn't go along with his story to the auditor about what these things were and how it worked. So in any event, this was an $18 million quote loan that the Justice Department said there was no intention to repay. There was $18 million of income. And the Justice Department position was the CPA should have known. The CPA did that, should have known, failed to follow up. And so he basically aided and abetted in the evasion of taxes. And he was convicted. And yes, he was sentenced in December of last year to some time in prison, followed by supervised release. Now, this is a sad story because the CPA in question was toward the end of his career with a large local firm. He's basically had his life destroyed by this thing. There's no question. And you may want to go get the article to read about it, but it's not a happy story. And here's the problem, though. Now, maybe you're not working with $18 million advances, but unfortunately, I have been in discussions with CPAs where, let's say, a client took too much from their S corporations during the year. They exhausted the basis, and so they took an additional $25,000. I have heard CPAs attempt to argue that, just make a journal entry to record that $25,000 as a loan to the client. And that's a problem. Ladies and gentlemen, that's not a loan. Now, see, a loan has to have a problem. There has to be, first thing is, and this has come up in multiple occasions, there needs to be an intent. What was the intention at the time the money was given to the client? And I've got news for you. At the time that money was given to the client saw that as a distribution. Well, they might even call it a draw because they keep thinking they're like partnerships. They didn't see it as a loan. And a key part about a loan is it's not a loan if there's no intention to repay it. Okay? That's going to be issues. If we do not intend to repay a loan, it's never a loan. And then number two, we don't have documents drawn up. We don't have them repaid. Be careful here. This can get CPAs in trouble in malpractice cases, can get CPAs in trouble if it gets big enough in criminal cases. Normally, DOJ's going to prosecute only where there are bigger numbers. But you know what? These numbers start out small. But what happens is, even though they were small when they started, there's this bias to just, you went along with 25,000. So how can you say 50 is not right? You went along with 50. How can you say 100 grand is not right? You went along with 100. How can you say $500,000 is not right? Eventually, you're up to some much, much bigger numbers. So be careful. Well, remember, don't get left behind. Register for your 2019 CPE. All the state society catalogs are out. We're doing courses right now. I'm doing courses. Like I said, I'll be back in New Jersey. I'll also do 2 days coming up in Oregon again, this time on tax. So I do tax this time. I'm not doing A&A this time. I'm doing tax. I enjoyed the A&A day. It's kind of nice for a change, but I am going to be doing traditional tax toward the end of June down there, or toward the end of June down in, down up there in Portland. So I'll be doing a couple of days there on taxes, including multi-state taxes again in that area. And I'll be doing some other places. I'll be doing some in Arizona here next month, doing one in Tucson on preparing complex 1040s. And again, if we get this retirement bill, I know we're trying with Arizona right now to find some way to do a course on that if we actually get a bill. That's a big catch. We have no idea when the bill's coming, so we can't really pick a date till we know that. So let's stay tuned and watch that. This has been the Current Federal Tax Developments for the week of May the 28th, the week after Memorial Day. You can follow our posts online at currentfederaltaxdevelopments.com to see about new developments and things happening. Be sure to check your State Society of CPAs website for all the continuing education courses we're going to be providing this year among Kaplan Financial Education. If you have any questions or comments, you can send them to me, edzollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. There I'm at edzollers. And I also do discussions. I've always mentioned I follow the Connect sites for the New Jersey, Minnesota, and Arizona Society of CPAs. I also follow the Tax Talk group for the California Society. Members only for the Connect groups, basically. But any CPA license in any part of the country can apply to get into the Cal CPA Tax Talk group. So if you want to get in there, do it. Otherwise, we'll look forward. We'll see what happens this week. We still won't know what's going to happen to the retirement bill, I'm pretty sure, by the end of the week. But we'll see what other developments take place. And we'll talk to you again with current federal tax developments next week as we look at what exactly has been going on in the area of federal taxes.